You're closer than you think. Most traders quit right before the breakthrough. Not because they lack skill, but because they don't recognize the signs that they're evolving. Today, I'm going to give you 5 brutal, honest signs that you're on the edge of becoming a consistently profitable trader. And if you see yourself in these, then you don't need a new strategy, you need persistence. At some point in your trading journey, something subtle but powerful begins to shift. You no longer feel the constant urge to be in the market. In the beginning, every small movement looks like an opportunity you cannot afford to miss. You sit there watching charts, feeling like if you don't act now, you'll lose out. That urgency pushes you into trades that don't meet your criteria, trades driven by emotion rather than logic. But as you evolve, you begin to understand a truth that most traders never fully accept. The market will always be there, but your capital might not. Instead of reacting to every price movement, you start to wait. And waiting is uncomfortable at first. It feels like you're doing nothing, like you're falling behind. But in reality, you're doing the most important work a trader can do. You're protecting your discipline. You begin to realize that not trading is a decision, and often it's the best one you can make. This is where patience transforms from a passive trait into an active skill. You start filtering opportunities with a sharper eye. You're no longer interested in maybe trades. You want clarity, alignment, and confirmation based on your strategy. If the setup isn't there, you simply let it go. This doesn't mean you've become indifferent, it means you've become selective. And selectivity is what separates amateurs from professionals. There's also a deeper psychological shift happening. You stop associating activity with productivity. Earlier, you believed that the more trades you placed, the higher your chances of making money. Now you understand that overtrading is often the fastest way to lose. Fewer trades executed with precision and confidence carry far more value than constant, scattered decisions. Patience also strengthens your emotional control. When you're not jumping in and out of trades, you reduce the emotional roller coaster that comes with it. You're no longer glued to every tick, feeling stress with every fluctuation. Instead, you operate with a sense of calm. You know your plan, you trust your process, and you wait for the right moment to act. This calmness is not accidental, it's earned through experience and self-awareness. Another important aspect is how patience improves your timing. Good trades don't just require the right direction, they require the right moment. By waiting, you allow the market to reveal its intent more clearly. You're no longer guessing, you're observing, analyzing, and then acting when the probability is in your favor. This doesn't guarantee success in every trade, but it significantly improves your consistency over time. It's also worth understanding that patience is directly linked to confidence. When you truly believe in your strategy, you don't feel the need to force trades. You trust that opportunities will come. This trust removes the fear of missing out, which is one of the biggest drivers of impulsive behavior. Instead of chasing the market, you let the market come to you. In the end, this shift toward patience is a sign of maturity as a trader. It shows that you're no longer driven by excitement or fear, but by discipline and logic. You've moved from reacting to controlling, from chasing to waiting. And while it may not feel dramatic in the moment, this change is often the turning point, the moment where consistency begins to replace chaos and where real profitability starts to take shape. There comes a moment in your trading journey when losses stop feeling like personal attacks. Early on, every losing trade feels heavy. It shakes your confidence, makes you question your ability, and often pushes you into emotional decisions. You try to win it back quickly, jumping into another trade without proper analysis, hoping to erase the pain. This is where most traders get stuck, trapped in a cycle where emotions dictate actions and actions lead to more losses. But as you grow, something changes. The losses don't disappear, but your reaction to them does. You begin to see them for what they truly are, a normal and unavoidable part of trading. No strategy in the world can eliminate losses completely. Once you accept this, you stop treating each loss like a failure and start treating it like data. This shift alone is powerful enough to transform your entire approach. Instead of reacting impulsively, you pause. You step back and review what happened. Was the trade valid according to your system? Did you follow your rules? If the answer is yes, then the loss is simply the cost of doing business. If the answer is no, then it becomes a lesson, something to learn from and improve. Either way, you gain something valuable, and that keeps you grounded. Emotional control after losses doesn't mean you become numb. You still feel disappointment. It's natural. But the key difference is that the emotion doesn't control your next move. You don't rush back into the market to get even. You don't increase your position size out of frustration. You remain steady, sticking to your plan regardless of the outcome of the previous trade. This consistency is what protects your capital over time. One of the biggest dangers in trading is revenge trading. It's driven by the need to prove something to yourself or to the market. After a loss, there's an urge to jump back in immediately, often with more risk to recover what was lost. This behavior is destructive because it's rooted in emotion, not logic. When you reach a stage where you can experience a loss and choose not to react impulsively, you break free from this pattern. That's a clear sign of progress. Another important change is how you view your performance over time. Instead of focusing on individual trades, you start thinking in terms of a series of trades. You understand that profitability is determined over dozens or even hundreds of trades, not just one. This perspective reduces the emotional weight of any single loss. It allows you to stay focused on execution rather than outcome. Your confidence also becomes more stable. In the early stages, confidence rises after wins and collapses after losses. It's inconsistent and fragile. But when you develop emotional control, your confidence is based on your process, not your results. You trust yourself because you know you can follow your rules, manage your risk, and stay disciplined even when things don't go your way. This level of control creates a sense of calm. You're no longer on an emotional roller coaster reacting to every win and loss. Instead, you operate with clarity. You know that losses are part of the journey, not a sign that you're failing. And because of that, you don't panic, you don't force trades, and you don't abandon your strategy at the worst possible moment. In the end, mastering your emotions after losses is one of the strongest indicators that you're getting close to consistency. It shows that you've moved beyond the beginner mindset and into a more professional way of thinking. You're no longer trying to avoid losses, you're learning how to handle them. And that ability is what keeps you in the game long enough to succeed. There comes a stage in trading where the real battle is no longer about finding the perfect strategy, it's about trusting the one you already have. In the beginning, doubt is constant. You question every setup, every entry, every exit. Even when you have a plan, you hesitate. You look for confirmation from indicators, from social media, from other traders, anything that can make you feel safer. But this constant need for reassurance creates inconsistency, and inconsistency destroys results. As you develop, something starts to change. You begin to realize that no system will ever feel comfortable all the time. In fact, the best setups often feel the most uncomfortable in the moment. They go against your instincts. They make you question yourself. And that's exactly why most traders fail to execute them properly. They wait for the trade to feel safe, but by then, the opportunity is gone. Trusting your system means acting despite that discomfort. It means understanding that your edge doesn't come from being right every time, it comes from executing the same process over and over again. You stop trying to predict every outcome and instead focus on following your rules. This is where discipline takes over emotion. There is also a shift in how you view uncertainty. Early on, uncertainty feels threatening. You want guarantees. You want to know that a trade will work before you take it. But trading doesn't offer certainty, it offers probability. Once you accept this, you stop fighting the nature of the market. You understand that even a high-quality setup can fail, and that's okay. Your job is not to eliminate uncertainty, but to operate effectively within it. When you truly trust your system, hesitation begins to disappear. You see your setup, you execute, and you manage the trade according to your plan. There's no second guessing in the moment, no last-minute changes based on fear. This consistency in execution is what allows your strategy to actually play out as intended. Without it, even the best system becomes useless. Another important aspect is that you stop constantly switching strategies. In the early stages, it's common to jump from one method to another after a few losses. You think the problem is the system when in reality it's the lack of consistency in applying it. But when you start trusting your approach, you give it the time and repetition it needs to prove its edge. You understand that results come from a large sample size, not a handful of trades. This trust also brings a sense of clarity. You're no longer overwhelmed by endless information or distracted by what others are doing. You know what you're looking for, and you ignore everything that doesn't align with your plan. This focus reduces noise and helps you make cleaner, more confident decisions. It's important to understand that this kind of trust is not blind faith. It's built through experience, testing, and observation. You've seen your system work over time. You've reviewed your trades, refined your rules, and gained evidence that your approach has an edge. That evidence becomes the foundation of your confidence. There's still discomfort, though. That never fully goes away. Even experienced traders feel it. The difference is that they no longer let it control their actions. They've learned to act in spite of it. They know that growth and consistency exist on the other side of that discomfort. In the end, trusting your system is about surrendering the need to be right on every trade and committing to being consistent over time. It's about understanding that success in trading is not built on perfect decisions, but on repeated, disciplined execution. And when you reach the point where you can follow your plan without hesitation, even when it feels uncomfortable, you're no longer just trading, you're operating like a professional. At a certain point in your trading journey, your entire perspective begins to flip. In the beginning, your mind is obsessed with profit. Every trade you look at, the first question is always, how much can I make? You imagine the upside, calculate the potential gain, and get drawn into the excitement of what could go right. But this mindset is dangerous because it blinds you to the one thing that matters most, what can go wrong. As you mature as a trader, you begin to understand a harsh but necessary truth: survival comes before success. If you cannot protect your capital, you won't last long enough to become profitable. This is where your thinking starts to shift. Instead of focusing on the reward, your first instinct becomes risk. You look at a trade and immediately ask, if this fails, how much will I lose? That question changes everything. When risk becomes your priority, your behavior changes automatically. You stop taking random trades because you become more aware of the consequences. You start placing your stop losses with intention, not as an afterthought. You think carefully about position sizing, ensuring that no single trade has the power to significantly damage your account. This level of control creates stability, and stability is what allows consistency to grow. One of the biggest transformations here is the way you define a good trade. Early on, a good trade is one that makes money. But later, a good trade is one that follows your risk rules regardless of the outcome. You can take a loss and still consider it a successful trade because you managed it correctly. This shift removes a lot of emotional pressure because your success is no longer tied to unpredictable results, but to actions within your control. Focusing on risk also forces you to think in probabilities rather than outcomes. You understand that no trade is guaranteed, so instead of trying to maximize every opportunity, you aim to protect yourself across a series of trades. Small controlled losses become acceptable because they are part of a larger plan. What you avoid at all costs are large uncontrolled losses that can wipe out your progress in a single moment. Another key change is how you approach position size. Beginners often increase their size based on confidence or emotion. If they feel good about a trade, they risk more. But experienced traders do the opposite. They keep their risk consistent. They understand that confidence is not a reliable indicator of outcome. By risking a fixed percentage of their capital on each trade, they ensure that no emotional decision can lead to catastrophic damage. This mindset also protects you from one of the most common traps in trading: overconfidence after a winning streak. When you focus on profit, a series of wins can make you feel invincible. You start increasing risk, taking bigger positions, and eventually one loss wipes out a large portion of your gains. But when your focus is on risk, you remain grounded. You treat every trade the same, whether you've just won or lost. This consistency keeps you in control. There's also a deeper psychological benefit. When you know exactly how much you're willing to lose before entering a trade, fear begins to lose its grip on you. You're not entering blindly, you've already accepted the worst-case scenario. This acceptance brings a sense of calm, allowing you to execute your plan without hesitation or panic. In the end, shifting your focus from reward to risk is one of the clearest signs of professional thinking. It shows that you're no longer chasing quick wins, but building long-term consistency. You're not trying to get rich from a single trade. You're trying to stay in the game, protect your capital, and let your edge play out over time. And that mindset is what separates those who survive from those who eventually succeed. At some point, the excuses run out. In the early stages of trading, it's easy, almost natural, to blame everything outside of yourself. The market was manipulated. The news came out unexpectedly. The broker widened the spread. The strategy stopped working. These explanations feel comforting because they protect your ego. They allow you to avoid the uncomfortable truth that maybe, just maybe, the problem isn't external, it's internal. But growth in trading begins the moment you stop pointing outward and start looking inward. Taking full accountability is not easy. In fact, it's one of the hardest psychological shifts you'll ever make because it forces you to confront your decisions honestly, without filters or excuses. Every loss, every mistake, every missed opportunity, you begin to ask, what did I do wrong? Not to blame yourself emotionally, but to understand your behavior with clarity. This shift changes everything. When you accept that your results are a direct reflection of your actions, you gain control. Before, you were at the mercy of the market. Now you realize that while you can't control the market, you can control how you respond to it. That realization is powerful because it turns trading from something that happens to you into something you actively manage. Accountability also forces you to become more disciplined. You can no longer justify breaking your rules. If you take a trade that doesn't fit your plan and it loses, you can't hide behind excuses. You know exactly why it happened. This awareness creates a level of honesty that is necessary for improvement. You start holding yourself to a higher standard, not because someone else is watching, but because you are. Another important aspect is how accountability improves your learning process. When you blame external factors, there's nothing to learn. You simply move on, repeating the same mistakes again and again. But when you take responsibility, every trade becomes a lesson. You review your entries, your exits, your emotions, your decision-making process. You look for patterns in your behavior, identifying weaknesses that need to be corrected. This continuous feedback loop is what drives real progress. There's also a deeper psychological impact. Accepting responsibility removes the illusion of control over the market and replaces it with real control over yourself. You stop trying to predict every move and instead focus on executing your plan correctly. This shift reduces frustration because you're no longer expecting the market to behave in a certain way. You accept uncertainty and adapt to it rather than fighting against it. It's important to understand that taking responsibility does not mean being overly harsh on yourself. It's not about self-criticism or negativity. It's about being objective. You're not saying I'm a bad trader. You're saying that decision didn't align with my rules. This distinction matters because it keeps your mindset constructive rather than destructive. Accountability also builds confidence, but not the fragile kind that depends on winning. It builds a deeper, more stable confidence based on your ability to handle situations correctly. You trust yourself because you know you will follow your process, manage your risk, and learn from your mistakes. This kind of confidence doesn't disappear after a loss because it's rooted in your actions, not your results. Perhaps the most powerful part of accountability is that it eliminates helplessness. When you stop blaming external factors, you stop feeling like a victim of the market. You realize that improvement is within your control. Every mistake becomes an opportunity to get better rather than a reason to feel defeated. In the end, taking full responsibility is the turning point. It's where you stop searching for external solutions and start refining yourself. It's where excuses are replaced with action and frustration is replaced with clarity. And once you reach this stage, you're no longer just participating in the market. You're evolving within it with a mindset that is built for long-term success.